Welcome to the Achievable FINRA podcast. I'm Tyler, the founder of Achievable, and we have affordable courses for the FINRA SIE, Series 6, Series 7, 63, 65, and 66 exams with industry best pass rates. Each Achievable course includes everything you need to pass the first time. A full textbook, videos on key topics, thousands of questions backed by our memory-enhancing algorithm, and full-length practice exams. You can try it out for free at achievable.me. And if you like it, use the code podcast to get you 10% off at checkout. This podcast was made from a video by Achievable's FINRA course author, Brandon Rith. If you'd like to have the visual aid of a video, please go to Achievable's YouTube channel and search for the video by the same name.
Let's talk a bit about short straddles, which involve two moving parts, in particular a short call and a short put together as one strategy. And if we think about that term straddle, a lot of people think about getting on a horse and having legs on both sides. A straddle allows an investor to kind of play the market on both sides. Now, short straddles are a little bit more narrowly focused on what the investor is hoping happens. But of course, we have two different parts of the strategy that are pointing us in two different directions. Let's talk about how you identify a short straddle, what are the mechanics of this type of strategy, and how to approach test questions on this topic. Now, the first thing we need to do is just simply establish what a short straddle is. You could easily encounter an identification question on the exam. A short straddle is when you are short a call and short a put simultaneously with the same strike price and same expiration. For example, let's assume we're short one March 45 call and short one March 45 put. We've got a short call, short put, same strike price, same expiration. This is a short straddle. If either the strike price or the expirations or both are different, this now becomes a combination. So for example, let's say one of these had a strike price of 55, the other one had a expiration of February. We now have a short combination in front of us. The most common combination question on the exam is typically an identification question. Here's this thing, kind of looks like a straddle, guarantee a straddle will be one of the answers that they give you, but either the strike prices are different, the expirations are different, or maybe both are different. If any one of those three scenarios is the case, then you have a short combination on your hand. Now let's bring it back to the short straddle. If we think about how short options work, investors that sell options are hoping those options expire worthless. That is when they experience their maximum gain. Calls are only exercised if the market price is above the strike price. Call up. Puts are only exercised if the market price is down below the strike price. Put down. So we're basically in this weird scenario where we don't want the market price to go above 45 because the call will get exercised, and we don't want the market price to go below 45 because the put will get exercised. Another way of saying we would love the market to stay right at 45. And in fact, that is where our maximum potential gain will come from. If the market price stays flat right at the common strike price and is there through expiration, then the investor could potentially see both options expire. Now, of course, a market price of exactly 45 is relatively unlikely, and I would say probably pretty rare to occur, at least for that to be the closing price on the expiration date. If the market price is even a little bit above 45 here, that call is going to get exercised and the investor will lose some money through the exercise. If the market price is even a little bit below 45, the put will get exercised and they'll lose a little bit of money through the exercise. Now that sounds a little scary. The market price is a little bit above 45, we're going to lose some money. If the market price is a little bit below 45, we're going to lose some money. So you might be wondering, who the heck would do this crazy strategy? Here's one thing you might not have thought of. The investor is selling two options and is collecting two premiums up front. That can be a substantial amount of money. So the market wouldn't just need to go up a little bit above 45. It would have to go high enough to potentially offset both premiums received up front. And oftentimes this means a pretty drastic move upward above the strike price or below the strike price, depending on what angle we're looking at it through. Now, if we put those ideas all together, a person that goes short a straddle is hoping for market neutrality, or we might say a flat market. The closer we can get that market price to 45 and the more it can stay at that price, the better. We don't want it to deviate very far from 45. the more it deviates away, the more money we could potentially lose. At this point, we've laid a little bit of foundation for short straddles. From this point onward, let's look at a practice question together and pick apart how to get to things like maximum gain, maximum loss, break even, what happens at this market price. This is a question that has 5 different parts to it. Good news, you're not going to see a 5-parter question like this in the actual exam. This is just written this way to make sure that we can cover as much information in this video as possible. If you want to, go ahead and take a moment, pause the video, and see if you can answer these 5 questions. Once you hit play, then we'll look at it together. All right, let's look at the question. We have an investor that engages in the following option strategy. They are short 1 KO 45 call at $8.50. They are short 1 KO March 45 put at $3.50. The strategy was initiated when the market price was 46. Then we have 5 questions below. Now, the $46 market price they give us is not important. Typically, as you might already know, whenever a market price is given, when we're talking about establishing an option strategy, that is typically irrelevant, unimportant information, as it is here. All this tells us currently is that the call has intrinsic value and the put doesn't. That's it. But for the questions being presented here, we need to go way further than just that. The first thing we're going to start with is our maximum gain. As we already talked about, option writers, also known as people that just sell options, hope that those options expire worthless. That is the ultimate goal. If these options expire worthless, we keep the premiums and don't have to do anything at all. So we need to ask ourselves, is it possible that both options expire worthless? Let's take it step by step. The 45 call is in the money and will get exercised if the market price is above 45. The 45 put is in the money and will get exercised if the market price is below 45. So if we think about it, both options will expire at 45. At that point, both options are at the money, but at the money options are not exercised. They need to be in the money. They need to have intrinsic value to be exercised, and that is not the case. While this is a narrow price range, in fact, it's as narrow as it gets, it's to the penny, $45. It's possible both options expire worthless if the market price stays at 45 through expiration. And if that's the case, they keep the $8.50 premium and the $3.50 premium, which is a total premium of $12. Another way of saying $1,200 overall. On to maximum loss. At this point, hopefully you know that selling options can be incredibly risky. And the problem is we have 2 short options. So it's like we have double extra risky stuff in a short straddle. Again, we'll look at this on a leg by leg basis. Let's focus on the short call leg first. This investor has an obligation to sell stock at 45, and there's no indication they have any kind of protection, any kind of hedge, or own the stock. So we'll just assume they have unlimited risk potential. The further the market price rises, the more money they lose. Now, with that being said, the only thing we need to figure out is, will the other side of the strategy prevent that from happening? Will a short put prevent an investor from losing unlimited amounts of money on the short call? And the answer is no. If the market price rises substantially, that short put will just expire worthless. Yes, the investor will keep the short put premium, but the more the market price rises, the more money they lose. And there's nothing worse than an unlimited risk potential. So with that being said, short straddles have unlimited risk potential because of the short call aspect. Next, let's look at break even. In the long straddle video, we talked about how break evens on straddles are relatively simple once you figure out how to do them. And it's the same process with short straddles as we did with long straddles. All we need to do is add up the 2 premiums, which is a total premium of $12 per share. Now from there, we just need to add and subtract that $12 from the common strike price. 45 plus 12 is 57. That's one break even. 45 minus 12 is 33. That's the other break even. And if you think about it a little bit further, those should make sense. At 57, the short call is $12 in the money. It has $12 of intrinsic value, and that works against the investor. The investor loses that $12 on the short call. That $12 will then be offset by the $12 made up front by selling the 2 options. On the other end, at 33, the short put is $12 in the money. The investor will be required to buy stock at 45 when it's only worth 33. That's a $12 loss. That $12 loss is then offset with the 2 combined premiums the investor made up front. Now, to think about everything from a big picture standpoint, the investor here will profit if the market price is somewhere between those 2 break evens. Between 33 and 57, that's profit territory. Above 57 or below 33, that is loss territory. If you recently watched the long straddle video, one thing you'll notice is that this visual is the exact opposite of what we saw there. And that should make sense. Investors with long straddles look for volatility volatility. So they want to see the market price go way up or way down. But investors with short straddles want neutrality or flatness to the market. They want the market to stay as close to the strike prices as possible. The closer, the better. The next question asks what the gain or loss is at expiration, assuming the market price is at 41. The first thing we'll do is figure out which option, if any, is in the money. Because otherwise, if they're both out of the money, then both will expire. Call up. Calls are in the money if the market price rises. Are we above 45? Nope. Put down. Puts are exercised if the market price falls below the strike price. Are we below 45? Yes. So that short put is in the money by 4. As you know, investors who go short options do not want their options to go in the money. Now let's just see, did we lose enough money to get to an overall loss? Spoiler alert, we did not. At 41, the option is $4 in the money. That means that when they get exercised, they'll have to buy stock at 45 that's only worth 41. So that's a $4 loss per share on the exercise. But we're going to offset that with the $12 per share received up front through the 2 premiums. So we made $12 up front, lost $4 on the back end, which leaves us with an $8 per share gain or an overall $800 gain in this example. The last question, what is the gain or loss at expiration if the market price is 59? We'll do the same thing over, maybe a little backwards first. Put down, puts have intrinsic value and get exercised if the market price is below the strike price. Are we below the strike price? No, 59 is well above the strike price. Call up, is the market price above the strike price of the call? Yes, that call is in the money, has intrinsic value, and we can assume it's going to get exercised. They have an obligation that they will have to fulfill, which will require them to sell stock at 45. There's no indication in the question that they have the stock already, so they'll need to go to the market, buy the stock in the market at 59, sell it at 45 through the option exercise. That's a $14 loss. Offset that with the $12 gained up front, we get to a $2 loss on a per share basis or an overall $200 loss. Straddles certainly are a little tricky, but if you use the tools we discussed in this video, hopefully it will help you consistently identify straddles and get the questions they ask on these strategies correct.